IKS, it's the new kid on the block now. It's an IT company it's a IT company which is giving differentiated services. When a company is giving differentiated services, how should you really analyze the numbers? Market are accustomed to looking at numbers, what we say as constant currency growth, quarter on quarter. I like to use the word QSQT, quarter se quarter tak, when we look at IT companies. But for IKS, is the story quarter se quarter tak or year se year tak? So let's understand the company, their first numbers, factors at play, what AI could do essentially. DeepSeek, we all spoke about it. Is that a threat or is that an opportunity? Sachin K. Gupta, founder and CEO, along with Nitya Balasubramaniam, Chief Financial Officer with Invertis. They both join us now. Nitya, every time I see you on the channel, I said, "Arey, pharma ka ek sawal पूछ लेते हैं, right? IKS से बाद में पूछेंगे."
Another time.
But IKS, you are presenting IKS. I shall start with IKS. Sachin, so how should we look at your numbers? These are your first numbers after you've gone public. We cannot compare you with a traditional IT company, but markets, they tend to do this QSQT comparison. Should they do it? Should they not do it?
Yeah, so thank you for having us on the show, Nikunj. Great to speak to you. So look, I think just to quickly recap, when we were coming out to the street, we had laid out some execution themes for ourselves. And I'd just like to quickly recap those because that'll help put the numbers in perspective. So when we actually made this major acquisition in FY24, we had set out on three big themes for execution. One, we would integrate AQuity, which had nearly doubled our revenues. And in the integration process, we would churn out their small customer tail. So they had nearly 800 customers. IKS had 50 customers. Our idea was we would prune out their customers such that we would together then focus on 500 large customers where the real growth opportunity is. So one theme for FY25 was we will cut the AQuity tail of small customers. Second, we were going to transform AQuity margins, which had taken the legacy IKS margin of 37-38% EBITDA on a blended basis down to 24% because of their low margins, because they did not have much technology and or global execution. And so we had our plan was to really start to bring the margins back towards the legacy IKS margins by incentivizing their customers to transform the delivery model. And then the third was to activate the cross-sell motion, which was the really big thesis of the acquisition that presents a 80-90x growth opportunity from our current scale over the next 15-20 years as this sort of multi-decadal secular thesis of growth in US healthcare plays out. And I'm happy to note that in FY25 Q3, we've been able to execute better than our own expectations on all of these three themes. One, we've taken the total number of customers from 850 down to about 750 customers and improved our EBITDA margin in the process from a blended 24% to nearly 31%, which is a 24% year-on-year growth for the same quarter on EBITDA margins and a 28% growth in PAT margins. So we're ahead of our glide path on margin improvement and getting towards that mid-30 EBITDA margin that we think we will settle at. We've been able to cut down the small customers and will continue to do so over a period of time. And in spite of the dampening effect of that on the overall consolidated revenues, we've delivered a 16% year-on-year growth performance on the top line. So I think all in all, a pretty successful quarter from a theme execution perspective and sets us up for a very strong Q4 and beyond, because in Q4, we will start to see the cross-sell motion getting activated as well, which will then provide some further momentum to the growth. So I think on a macro basis, I continue to maintain our thesis that here is an opportunity to grow significantly in a $225 billion TAM, of which only $30 billion has been outsourced, and that outsourced TAM is growing at 12%. We feel as leaders in this space, we have the right to grow significantly faster than that 12% on top line over a long period of time, and then continue to drive non-linear growth from a margins perspective because of the tech transformation that we're driving. And that is driven predominantly through a whole bunch of proprietary AI-based technology that we are embedding across our platform.
Just to take a leap from Sachin's answer, the industry is growing at 12%. You are growing at 16%. Because you're the market leader, I would assume that 15-16% growth for many years is here to stay.
I think that's a reasonable assumption. I would be disappointed if over the next several years, if not decades, we are not able to demonstrate that type of growth.
Nitya, before the acquisition kicked in, Nitya, the margins which IKS enjoyed were closer to 40%. Post the acquisition, the margins have come down. Now that the acquisition has got stitched in, could you go back to the original margin picture or number which you had, let's say in FY23 and FY22, which was closer to 40%? Because if you achieve that, that is explosive growth.
I think, like you're pointing out, legacy IKS margins were around the 38-39% mark. And if you look at FY24, our pro forma combined financials of 12 months of both the entity, IKS and Acuity, had actually slid down to 24%. But what we are actually very happy to report is from that 24%, we have actually been able to achieve significant strides in terms of our ability to transform Acuity's margins. Which is why if you look at this quarter numbers that we've reported, that 24% has already expanded to 30.5%. And in the future, we think steady state, we should be able to get to mid-30s. And again, we have actually been able to accelerate that path towards the mid-30s steady state margin that we want to achieve.
Okay. How will the transformation happen, Sachin, if you can tell us? So you've given us a sense of 15% top line growth, which is at a 50% premium to the IT industry. I'm using that as a benchmark because invariably you would be compared with what IT services is doing. So when you say that gradually margins will start improving, will we see a quarter-on-quarter jump? It could be 50 bips, it could be 100, it could be 100 bips, but gradually you will start inching higher, which means that by FY27, we can add back 16% growth, we can add back margins, and we can look at a completely different earnings trajectory. Are you at the cusp of a transformational change then, Sachin?
Nikunj, I think suffice to say our Q3 performance indicates that not only are we at the cusp of it, that we are actually embarked on that journey. And so one does expect a relatively rapid expansion of margin from here towards that steady state 35%. Whether it ends up taking 12 months, 18 months, time will tell. So far, we have surprised us of the pace at which we've been able to accelerate margins. So we hope to continue that trajectory. And on the growth of top line, I think, in my opinion, we have only started that journey. As that cross-sell into the Acuity customer base kicks in, we hope to accelerate that even further.
And Nikunj, if I might add, I think in the near future, you will continue to see that accelerate, that earnings growth is far more at an accelerated pace than the revenue growth. And even after we achieve our steady state, as we continue to deploy the technology investments that we are making, you'll continue to see the non-linearity in between revenue and earnings growth.
Good morning, Mr. Gupta, as well as Nitya, Cheryl joining in. I just wanted to understand a bigger, larger scheme of things right now, given the fact that you have Donald Trump at the helm in the United States. A lot of commentaries coming in actually from there, that the fact that they are going to look at cutting Medicare spending. There's also risk to startups in the United States, especially when you talk about the new tech and the way how the AI is working out. Have you all chalked out a plan? Are you all actually revisiting your plans based on these reports coming in?
So, two aspects to your question, Cheryl. One, all the efficiency that the Trump administration is driving towards. I think Elon Musk put out a report that said that there's $1 trillion of potential waste in the $5 trillion US healthcare industry. I'm happy to note that the entire foundation of our business model is to actually drive efficiency, reducing cost and improving quality of care in US healthcare. So I think any moves that are made by the administration in that direction are only going to be a tailwind for our business. As it relates to the use of technology and AI, actually we began on this journey back in 2018 with the use of first non-cognitive RPA, then RPA. We've announced in our this quarter's earnings that we've actually rolled out a fully autonomous Gen AI NLP-enabled clinical documentation technology. There are 7 or 8 other use cases of Gen AI that we are working on actively. We're building a Gen AI center of excellence. And then slowly but surely, we're actually even starting to move towards agentic AI, where we will enhance the Gen AI capabilities of creating complex content to take them to a level where once the technology understands the goals, it is able to make autonomous decisions and execute towards that goal. So it's sort of that journey from RPA to Gen AI to agentic AI that we are on.
All right, but also help us understand that, Nitya, I would like to come to you, that how is this whole AI thing shaping up and contributing in your industry? We have heard a lot about what's happening with DeepSeek and what the US government is actually also looking at. So given the fact that there's been so much of development in this AI, how is your industry and your company specifically looking at in this particular space right now?
I think we've always mentioned that technology is a very high priority for us. If you actually look at our R&D spends, which again, everything is reflected in the P&L numbers, and R&D spend already stands at 5% of sales. So I think one of the things that's very unique about our model is that our pricing is entirely outcome-based. So therefore, we are fully incentivized on an ongoing basis to continue to deploy a lot of tech in our features and therefore take benefit of the leverage that tech will then bring us in terms of improved margins. So we've been able to demonstrate that consistently over the last decade or so. And, I did mention that we continue to invest in technology as well. So going forward as well, you'll continue to see that leverage in the margins play out as we deploy more and more tech in each of our 16 features. We already have 6 to 7 use cases of Gen AI already deployed across our features. And what we are now investing in is agentic AI. So you'll actually see us step up and lead the technology-led transformation in each of our features.
Before we wrap, let's understand the risk to your business. The risk to your business, is it macro, which is some radical changes they happen to the US healthcare policy, or is it technology, where just like DeepSeek in a sense, I had to rub my eyes when I read the news that how can something be developed at that cost? So could it be technology? Could it be regulation? What is the risk to your business?
Nikunj, great question. And I think both of them are in equal part risks and opportunity. So macro policy could be a risk to our business, just like it could be to the entire $5 trillion US healthcare industry, especially if America decides to move to some sort of a single payer delivery system, which like the UK or Canada. And at the same time, if they continue with the current macro structure but try to drive efficiency, policy could be a huge opportunity. Similarly, on technology, we're investing very significantly on technology, and we right now look at it as a huge tailwind. But could there be a super smart technologies that fundamentally changes the paradigm on technology and leapfrogs it? Perhaps, that's possible. But one thing we've seen, Nikunj, in healthcare is that the technology still needs human supervision because we're talking people's lives and safety is important, and the technology does come with its biases. So the fact that we have combined technology with our proprietary human-in-the-loop model gives me confidence that technology will continue to be an opportunity for us and a tailwind versus a risk. But you're right that both policy and technology could be risk or opportunity in equal part.
Nitya, Sachin, great to have you. Thank you for joining us, and certainly hope to see much more of you going forward.
Thank you for having us.
Having us.